As you know, this is a chapter on limited liability companies and special forms of doing business. Originally was recorded without audio because the um, microphone function on my laptop appears to have died. But I now have a microphone and we'll try again. Here's the chapter outline: limited liability company, LLC operation and management, dissociation and dissolution of an LLC, and special business forms. Learning objectives. What advantages do limited liability companies offer to business persons that are not offered by sole proprietorships or partnerships? What are the two options for managing limited liability companies? What happens when a member dissociates from an LLC? What is a joint venture? How is it similar to a partnership? How is it different? The nature of the LLC. Limited liability company, or LLC, is a hybrid form of business enterprise that offers the limited liability of a corporation and the tax advantages of a partnership. LLCs must be formed and operated in compliance with state law. A member is a person who has an ownership interest in an LLC, and that member is shielded from personal liability in most situations. The liability of members normally is limited to the amount of their investments. The members of an LLC, like the shareholders in a corporation, can lose their limited personal liability in certain circumstances, such as when an individual guarantees payment of a business loan to the LLC, or when an LLC member fails to comply with certain formalities, such as by commingling personal and business funds. Under various principles of corporate law, courts may hold the owners of a business liable for its debts. As LLCs are legal entities apart from their members, they can sue or be sued, enter into contracts, and hold title to property. The formation of the LLC. To form a limited liability company, articles of organization must be filed with a central state agency, usually the Secretary of State's office. In the state of Florida, it is the Secretary of State's office. Articles of organization. The document filed with a designated state official by which a limited liability company is formed. The articles must include the name of the business, its principal address, the name and address of a registered agent, the members' names, and information on how the LLC will be managed. The business's name must include the words Limited Liability Company or the initials LLC. Federal law does not mention the citizenship of partnerships, LLCs, and other unincorporated associations, but the courts have tended to regard these entities as citizens of every state of which their members are citizens. Advantages of LLCs include a member's personal liability being limited to the amount they invested into the LLC. LLCs with two or more members may elect to be taxed as a corporation or as a partnership, and flexibility in management and operations. I might note that an LLC that has a single member is automatically treated for tax purposes as a sole proprietorship. Key disadvantages of the limited liability company form of operation. LLC statutes are not uniform between the states. Non-uniform state LLC statutes create uncertainty as to personal liability and the respective authority of the LLC and its members. LLC operation and management. LLCs are typically either member managed, meaning that all of the owners of the LLC participate in its management, or manager managed, meaning that a designated group of persons, some or all of whom may be non-members, manage the LLC. Under the Uniform Limited Liability Company Act, the ULLCA, managers in a manager-managed LLC owe fiduciary duties, the duty of loyalty and the duty of care, to the LLC and to its members. Operating agreements. An agreement among the members of the LLC that sets forth the details of the business's management and operations, addressing such issues as management and how managers will be chosen, how profits will be divided, how membership interests may be transferred, whether the dissociation of a member will trigger dissolution, member meetings, voting rights, and how to calculate a buyout price in the event of a member's dissociation. It is not dissimilar from a partnership agreement. All right, Exhibit 28-1 is a chart showing the two styles or types of LLC management. Member managed gives every member a vote on decisions with the majority controlling. Most LLC statutes assume the firm will be member managed unless the articles state otherwise. On the other hand, manager managed members designated person or a group of persons to manage the LLC, which may include non-members, and the members normally specify that the LLC is manager managed in the articles of organization. Dissociation of an LLC. Unless the operating agreement says otherwise, a member may dissociate from the LLC voluntarily. In addition, the ULLCA allows members to be dissociated by a vote of the other members, by a judicial order, or by the order of an arbitrator, or due to the death, incapacity, bankruptcy, or assignment of a partnership interest for the benefit of creditors. A member's dissociation generally does not cause the LLC to cease doing business. A member who ceases to be associated with the LLC forfeits their authority to act for the LLC and to participate in its management, and is normally entitled to have the remaining members purchase his or her interest. Members can also stipulate in their operating agreement that certain events will cause dissolution, or they can agree that they have the power to dissolve the LLC by vote. Once an LLC's dissolution is formalized and any required notice has been given, the members must wind up the LLC's affairs. That is, collect and preserve the LLC assets, pay the LLC debts, and account to each other member for the value of their personal interest in the LLC. LLC assets are distributed as follows: payment of third-party debts and refunds of loans or advances made by members to or for the LLC, and then a return of each member's capital contribution and distribution of profits to the members in equal shares, unless otherwise agreed. Special business forms. Joint ventures are a joint undertaking by two or more persons or business entities to combine their efforts or their property for a single transaction, or a single project, or for a related series of transactions or projects. A joint venture is generally treated like a partnership for tax and other legal purposes, but is not in fact a partnership. Joint venturers owe each other the same fiduciary duties, including the duty of loyalty that partners owe each other. A joint venturer can be held personally liable for the venture's debts because joint venturers share losses as well as profits. Like partners, joint venturers have equal rights to manage the activities of the enterprise, but they can agree to give control of the operation to one of their members. Joint ventures differ from partnerships in several important ways. A joint venture is typically created for a single project or a series of transactions. Thus, it normally terminates when the project or the transaction for which it was formed has been completed. Because the activities of a joint venture are more limited than the business of a partnership, the members of a joint venture are presumed to have less power to bind their co-venturers. Accordingly, the members of a joint venture have less implied and apparent authority than the members in a partnership, each of whom is treated as an agent of the other partners. Some other special business forms. The syndicate is a group of persons or entities who have jointly financed a particular project. For example, an offshore production platform. The syndicate may take the form of a corporation, general partnership, or limited partnership. Alternatively, the members of the syndicate may merely own property jointly and have no other business arrangement, which is awfully similar to a joint venture. A joint stock company is a hybrid form of business organization that combines characteristics of a corporation and of a partnership. Usually, a joint stock company is regarded as a partnership for tax and other legal purposes. It has many characteristics of a corporation in that its ownership is represented by transferable shares of stock. It is managed by directors and officers of the company or association, and it can have a perpetual existence. The business trust is a form of business organization created by a written trust agreement that resembles a corporation. Legal ownership and management of the trust property stay with the trustees, and the profits are distributed to the beneficiaries, who have limited liability. A cooperative is an association that may or may not be incorporated, that is organized to provide an economic service to its members. Unincorporated cooperatives are often treated like partnerships for tax and other legal purposes. This concludes the lecture portion on Chapter 28, Limited Liability Companies and Special Business Forms.